race. Our Leslie Picker is there now with the Bank of America CEO, Brian Moynihan, for CNBC Exclusive. Morning, Leslie.
Hey, good morning, Sarah. And Brian, thank you so much for being here. Really nice to sit down with you in person. I want to kick things off with rates because we've seen a pretty drastically different environment in recent weeks, with the long end of the curve coming down quite significantly. Concurrently, Bank of America's stock prices surged 17% in the month of November alone, besting most of its peers in the financial services industry in general, in large part in talking to investors and analysts who have a thesis on this. Because of the $131 billion in unrealized losses, the lower end of the curve coming down would, create some sort of a dent in that figure. So I'm curious how your plans for capital allocation change in a more benign rate environment.
Well, first, it's great to be here, Leslie, and we just here at the Goldman Conference all of us talking about the industry and the companies. And I think, look, you got to get to normal, and an inverted rate curve is not normal. And as the Fed has raised it to fight inflation, as inflation's tipping over and coming down, as the indicia of future inflation are coming down, the job openings today being lower, the unemployment rate going up a little bit, spending slowing down year over year. We can talk about all that, so that's happening. So the rate structure is settling in, and that has an interesting impact. If you have a lot of zero interest funds, the rates coming down don't help. But on the other hand, stabilization in rates means the economy will then kick in and activity will kick back up. So if you look at investment banking activity, slow this year because the uncertainty picking back up as people think there's certainty, and then we'll pick back up. So these things all work out and balance each other out. But we manage the company to be fairly balanced. So our interest rate sensitivity today is no different than it was 2 years ago to rising rates. That's because across $3.3 trillion of balance sheet and work, you're trying to keep the interest rate sensitivity relatively the same, so that you can then earn $14 billion NII a quarter.
But, lower rates has certainly been a tailwind, at least in November, because there is this perception that the underwater securities are, impacting NIM. There's an opportunity cost associated with that. You're turning over about $11 billion each quarter as these securities mature and get paid down. How much longer do you think the balance sheet will be something that analysts and investors continue to talk about?
Well, I think when we talk to people on the stock, they see the earnings power coming up. And so our NII projections, which reflect the whole company, are to basically come down, bounce along, and then grow next year. That's wholly different than anybody else. And part of that's the stability in the deposit franchise. And part of it is rates fall. The short rates, the people only have their money shorts coming down. We have $500 billion plus in cash and short-term securities on top of the $500 billion in change we have on the other side. So it's a balanced book, and so that we don't get hit as hard when rates come down, because if you're all short, that's going to hurt. But in there's floating rate loans. There's $3.3 trillion. But the difference between us is we see NII peaking back up. We're $5 billion higher than the trough a few years ago. We are now seeing it flatten out at this level and grow, and that's different than others because that's the power of the whole franchise, not in any individual part.
Is that true even if rates continue to go down? Because I know you had you're on track to produce about $57 billion worth of NII this year. That's 33% higher than 2021, obviously thanks in large part to a higher interest rate cycle this year. So do you think that peak benefit is behind us, or
no? In those projections is rate cuts next year.
Right.
Yeah. So we follow the curve. So as rate cuts next year and the year after that, our team has the economy troughing out to like a 0.5% growth beginning in the first part of next year through the middle, and then it starts growing a little stronger. They have 2 rate cuts next year, 2 to 3 rate cuts, and they have 4 the next year. So the rate structure will be higher, and in that rate structure, it's actually very beneficial to our franchise. What you need to do is have loans and deposits start to grow. So when we were at this conference last year, we would have had everybody talking about, will the deposits go back to where they were pre-pandemic? And we were trying to show people that if you took the growth rate in deposits, you were coming back to that level to be back on the trend growth rate. So for us, that's $1.5 trillion to $1.9 trillion. Our deposits are actually growing again. And so when those deposits grow at a cost of 150 basis points, whether Fed funds is 5.5 or 4, that's still a nice profit margin that we can get out of that, and that's what we do.